Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is January 29th, 2025, and we're diving into Adient's latest earnings report for the first quarter of fiscal year 2025. Joining us is John, a senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. Adient, a leader in automotive seating, has just released their Q1 FY2025 earnings report, and there's a lot to unpack, from revenue figures to strategic initiatives.
Revenue and profitability overview. Let's start with the top line. Adient reported net sales of $3.495 billion for the quarter, which is a decrease from last year's $3.660 billion. John, what does this tell us about their current market position?
While the net sales have decreased, it's important to note that Adient's gross profit stands at $216 million, down from $246 million. This indicates some pressure on their profitability, likely due to increased cost of sales and restructuring expenses. The net income also dropped to $25 million from $45 million, reflecting these challenges.
And the earnings per share.
The diluted EPS for this quarter is reported at $0, which is a significant drop from 21 cents last year. This is a clear indication of the financial pressures the company is facing.
EPS forecast and analyst expectations. Analysts had forecasted an EPS of 32 based on a survey of 3 analysts. How did Adient's actual performance compare?
Adient reported an adjusted EPS of 27 cents, missing the forecast by door 5s. This miss can be attributed to higher restructuring and impairment costs, which impacted their bottom line more than anticipated.
What does this mean for investor sentiment?
Missing EPS forecasts can often lead to negative investor sentiment, as it suggests the company is facing more challenges than expected. However, it's crucial to consider the broader context, including their strategic initiatives and market conditions.
Operational efficiencies and future outlook. Despite the challenges, Adient has reported an adjusted EBITDA of $196 million. How does this reflect on their operational efficiencies?
The adjusted EBITDA margin of 5.6% shows that Adient is managing its operations efficiently, even with the revenue decline. Their free cash flow of $45 million is a positive sign, indicating good cash management practices.
And what about their debt situation?
Adient's net debt stands at $1.542 billion, with a net leverage ratio of 1.79. This is manageable, but they need to continue focusing on reducing debt to improve financial flexibility.
CEO/CFO statements and strategic initiatives. What strategic initiatives is Adient focusing on to navigate these challenges?
Adient is emphasizing cost management and operational efficiencies. They're also looking to expand their market presence in Asia, which has shown strong adjusted EBITDA margins. While we don't have specific statements from the CEO or CFO, the company's actions suggest a cautious optimism for the future.
How should investors interpret this?
Investors should keep an eye on how these strategies unfold, especially in terms of market expansion and cost control. These will be key to Adient's ability to improve profitability and shareholder value.
Key takeaways. To wrap up, Adient's Q1 FY2025 performance shows a company facing challenges, but also taking steps to address them. With net sales of $3.495 billion and an adjusted EPS of 27 cents, they missed analyst expectations, but are focusing on strategic initiatives to improve their position.
Indeed, their free cash flow of $45 million and manageable net debt are positives. Investors should watch how their strategies in cost management and market expansion play out in the coming quarters.
Thank you, John, for your insights, and thank you to our viewers for tuning in. Don't forget to like, share, and subscribe to Smart Stock Watch. We'd love to hear your thoughts on Adient's performance in the comments below.